Welcome to Commercial Real Estate Now. I'm your host, Carly Iacono. Today, I am so pleased to be joined by the COO of Urban Edge, Jeff Mooallem. Jeff, welcome to the show.
Thanks, Carly. It's great to be here. Thanks for having me today.
Really excited that you could join us today and cannot wait to dive into the retail strategy at Urban Edge. But before we do, give us a quick background on you and your role at Urban Edge.
Sure. Yeah. I mean, as far as my background, I started as an attorney, but I've been in commercial real estate for the last, I don't even want to say how many years, but over 20 years, and almost all of that in retail real estate. Urban Edge is a publicly traded company, so we're a REIT on the New York Stock Exchange, and we own roughly 75 shopping centers, most of them from Washington, D.C. up to Boston, so what we call the Amtrak corridor. And those take the shape of grocery-anchored centers or power centers or lifestyle centers or whatever other terminology we like to use in the industry. But basically, we are a retail development, management, leasing, operating company. That's what we do. That's what we've been doing for the past 10 years. And we love the retail real estate business.
And you're darn good at it, I will say,
Thank
because
you.
one of my very favorite shopping centers happens to be owned by Urban Edge. And I go there frequently and think, this is beautiful. And you did such an amazing transformation. So we'll get into some projects.
Great.
But
I'll always love to hear that.
Just know that you're crushing it out there, which your stock price probably says. You probably don't need me to say, but good work.
Thank
you.
And it's a function of having a great team that really knows what they're doing.
I'm sure. So let's start with one of your favorite projects or something that you completed recently and some lessons from that experience.
Well, you set me up perfectly there because one of
I did.
our favorite projects at Urban Edge and something that we also recently did a big renovation on, completed recently, is the shopping center I think you're referring to, which is Bergen Town Center in Paramus, New Jersey.
Nailed it.
Yeah, it's 1.1 million square feet. And it's funny, those of us in the real estate business, we talk about lifestyle centers and grocery centers and malls and power centers. And we have all these different terminologies we use to categorize shopping centers. But the customer doesn't get out of bed on a Saturday morning and say, let's go to a lifestyle center or let's go to a grocery anchored center today. They say, let's go to Whole Foods, let's go to Target, let's go to Lululemon, whatever it might be. And Bergen Town Center is, in our minds, all things to all people. It has elements of all of those kinds of shopping centers with some of the bigger power center type users like Kohl's, Marshall's, Home Goods, but it also has the Whole Foods and the Target for the daily needs shopping. We've added some new restaurants, a lot of great seating areas. We've brought in some food trucks and kiosks, and the property is really looking at its best, and we're very proud of it. The next phase for it will be adding some more restaurants. Josh Capon, who is a great local chef and celebrity here in Bergen County, is opening up a Capon's Burgers there soon. He has a Capon's Chop House at Riverside Shops, not far from there. Tate Bakery and Cafe, which started in Boston, but I think is one of the most exciting food retailers in the country, will be opening in the next 30 days at Bergen Town Center. Tommy's Tap and Tavern, which is a very popular local chain, will be opening as well. Adding the food element to the shopping element to the walking around element is what makes, in our minds, a shopping center kind of the part of the community that always is going to stay there. And we're really proud Bergen Town Center can be that for Paramus.
You know, I think so interesting about that particular center is it's both practical. You can go buy what you need, right? Groceries, Target, but it's fun. You've managed to create an experience and an efficient shopping experience at the same time. And I think that's kind of hard to balance, right? We've a lot of centers in the US that are all high-end retail and they're beautiful and they're fun to walk around, but it's maybe not so practical. And then we have centers that are just, you go into the Target and you come out and that's it. I feel like you've struck a balance between the shopping experience and the mix of tenants that's hard to achieve, which is why I personally love going there, right? I could buy a gown for a black tie event, which I have done at Bergen Town Center. I can get my groceries at Whole Foods. I can have dinner with the kids. You can kind of do it all, whatever you need that day. So I think that vibrancy you've really nailed there.
Thank you. I'm going to pass that on to our team because they have worked incredibly hard to make that happen. And what you just described is, for me, that's what's so special about this business. You know, for your listeners who are thinking about whether to get into a career in real estate and whether that's in retail or some other, sector within real estate, I love the retail business. I absolutely love being in retail real estate because it is more art than science. It is not just a question of, what is the income, what are the expenses, therefore what is the NOI and how much can we finance it? But it requires a level of curation. And when you do it right and you put tenant A next to tenant B correctly and the Tivoli lighting above them and the signage in front and it draws traffic, you have an extremely productive and strong asset that you've added value to. And when you do it wrong, and we can all drive around any of our hometowns and see examples of right and wrong, when you do it wrong, that asset's going to go down in value and eventually tenants are going to leave. So there is a real element of creativity component that comes into owning a property like Bergen Town Center. You don't want to overspend. You don't want to overdevelop. We're not going to build something that's going to try to attract, full line department stores or luxury brands, because that's not who our customer is. But we also want to make it a special experience, a clean experience, a safe experience for people to want to come back over and over again with parents, with kids, have special events there. So we think we hit it on that one, and we're going to try to hit it on a few more here as well.
How do you balance that element of art, right? I think it's very easy to point to investment committees and say, here's the budget, here's what we think we need in CapEx, here's the TI for the tenants. Like, we talk numbers all day, both of us, right? But I think you brought up something that's harder sometimes to quantify,
Yes.
and that's the feeling, the art, the look from the road, but also when you walk in, the lighting. How do you handle that internally at committee? Is that you? Is that did you bring in outside designers? Like, what does that look like?
It's all hands on deck because it requires a lot of different expertise and skill sets from different people. And it is by far and away the most challenging and the most important part of our business to get right. You have certain capital expenditures you make that the customer doesn't see. You replace air conditioning units, or the roof needs to be repaired, or the parking lot needs to be seal coated. And you have certain capital expenditures you make that go directly to the tenants in form of tenant allowance or landlord's work inside of a specific space. And then you have this third bucket of enhancements that you can make to your property that you hope will generate more revenue, which comes from either better tenants or more sales from your existing tenants and therefore their ability to pay more rent. You hope that will be an accretive investment. And it isn't always an accretive investment. Sometimes you can put $2 million into a facelift for a shopping center and your income goes up $100,000 and you made a 5% return, and it's not great. But when you do it right, and at Bergen Town Center, we could walk through the math and be here all day. When you do it right, it should add value to your property, both in terms of what your existing tenants will pay as their leases come up, and new tenants that might now be drawn to your property that wouldn't otherwise come, Tate being an example for Bergen Town Center. And of course, there's always the opportunity, if you play it right, to maybe expand or add density or do other things with your property once you have a municipality that's supportive of what you're trying to do.
So how do you measure success then? It sounds like some of these are longer term, right? Paybacks on investment in the center. Some are going to be quicker. At what point do you look back and say that worked? It's a great question. So at investment committee, we'll look at the numbers, right? We'll sit there and say, all right, we're going to spend this much and our yield on it is going to be 8%, 9%, 12%. Or at Urban Edge, we've averaged about 14% yield on the renovation work that we've done on our assets over the last few years. Pretty good.
Yeah, it's great. Yeah. We hope we can maintain that. We have a $170 million development pipeline. If we can continue to churn away between 13 and 16% of yield on that, it's a very good story. But it's really about more than the yield, because retail assets are not assets that, maybe 50 years ago when some of these shopping centers were built, you signed 10-year leases and you forgot about them. But these assets now require constant TLC, and it's a good thing. So I can't tell you today whether Bergen Town Center is a single, a double, a triple, or a home run. It takes time to see how the customer responds, how our sales go up. The early returns are very good. But when we look at these projects, the investment committee analysis is yield-based. But the longer term view is, are we making this a better asset for this community and therefore, improving our position within the competitive set?
Let's talk about some other ways that you add value, right? We talked about the art of the center and kind of how you quantify that and the challenges there. What other concrete ways do you look to add value? Maybe if it's a new acquisition or even something you've owned for some time.
Yeah. So we have a lot of tools in the toolbox, and we try to look at all of them when a new acquisition comes up or when we're looking at one of our assets and doing sort of a strategic review of it. Certainly, renovation is one of the tools that we like to we like to employ. And we'll try to do that across 5 to 10, maybe even 15% of the profile of the portfolio at any given time, and constantly be refreshing the portfolio in that way. Another opportunity is expansion, densification. So going back to Bergen Town Center, we did take an underperforming building that was housing an REI and not much else and sell it to a great local residential developer who will start construction on building about 460 apartments there. So that's another 460 homes that will walk to our Whole Foods, that will walk to our Target, that will walk to our restaurants, and a much more accretive and financially lucrative use of the land for us than what was there. So that's a second arrow in the quiver is, expansion.
Let's pause there for a minute. I know there's more. I know there's more arrows in the quiver.
Always.
And that's a good thing. For the residential, are you seeing that be more welcomed by communities than maybe it was in the past? Is this something that's coming up more frequently across different markets, or is this one of the first examples that you've tried this with?
I think a lot of municipalities have embraced the importance of having shopping destinations and residential destinations be somewhat interconnected, right? It takes cars off of the road. It makes it for a more pleasant environment for the resident to be able to have shopping nearby. So generally it will lead to better product that gets maintained better, kept up better, because rents are going to continue to grow. And I think overall on a macro basis, I would say, yes, there's more support for residential coming into shopping areas. However, it is so jurisdiction specific. And I could probably give you 5 jurisdictions around the country where, we've banged our head against the wall a little bit, that they wouldn't be supportive of adding that. So it's very specific to the locale, both the county and the city. But in general, it's moved in the right direction over the last 20 years that I've been doing this.
And I love the point that you made that these are shoppers for your center. So it's not just that you're selling off excess parking, which wasn't the case in this scenario anyway,
right.
But it's not just, we have too much land, we're not sure what to do. It's not going to be retail because, retail shrinking. It's completely the opposite. This is a strategic plan for you to improve the retail by making it residential.
Yeah, I think
love
so.
That. Interesting.
And you always have to ask yourself, what's the tail and what's the dog? Because so many times we've all been to these residential buildings where they've built some retail space on the ground floor as sort of an afterthought.
Right.
And it doesn't work necessarily. The ceilings are too low. There's no great sign visibility. The parking is not there. The loading is not great for the retailer. And it's very clearly that the retail there is an afterthought. We are a retail first company. So to the extent we're going to do residential, it's going to be complementary to our shopping centers, add value to our shopping centers, and not sort of butcher the customer experience.
I love that. That's great. Great way to execute for sure. Okay, back to the other options you have when looking at adding value to a center.
Yes. Okay. So we covered sort of, renovation.
Right.
We covered sort of expansion. Mm-hmm. Along with expansion, we'll look at something like zoning changes, entitlement changes, right? That can always be something. A lot of times we'll see, and now we're getting into some of the smaller dollar things, but a lot of times we'll see maybe a prior owner didn't fully maximize what we would call ancillary revenue. Maybe there's some signage.
Like EV charging, that fall into that?
EV charging, it might be signage income. I mean, you have a shopping center that's near Newark Airport. Maybe you get Target to paint their logo on the roof and pay you for it.
Right.
We've tried all of those things at our assets, some with success, some not, but always looking for ways to sort of monetize that. Is there an unused parking area that could fit an out parcel? One of the things that's kind of exciting in our little shopping center world right now is there's lots of these sort of quick service, small format coffee operators that are coming to the East Coast where they have these prefabricated buildings and they can just drop them in on a postage stamp size lot that previously was not big enough for a Starbucks or a Wendy's or a Burger King or a Chick-fil-A or something. So now you're having the opportunity to take as little as quarter to half an acre and add a really cool coffee use to your property and get a little bit of extra income out of it. So that's another sort of area we look at. And then finally, I would say just sometimes working with your existing tenants. Are there expenses that can be reduced, which of course can go to the bottom line? Are there things that the tenant wants to see in terms of marketing efforts that could be made that help the whole shopping center? I have an example from a few years ago where we We had a tenant that was slow out of the gate when they opened. It was a beauty concept. And we did a fair. We had an unused parking lot because there was a large tenant that was under construction. We did an all-day fair, and it didn't cost us a lot of money, and it got some radio promotion and other things. And this tenant was able to, hand out a bunch of gift cards and things like that. And the real estate person, told me 2 months ago, that kind of kick-started our business there. People saw us. They knew we were there.
That's really tenant partnership.
Tenant
right?
partnership. So let's add it to the list in those words. Exactly. Tenant partnership, ancillary revenue, expansion, entitlement, renovation. Those are just some of the tools that we try to use.
And that's a sign of being a savvy landlord, right? You can't just buy it and expect it to cash flow exactly like it was for the foreseeable future. You really need to work the property, keep it current, right? Have those partnerships, be thinking about the expansion plans, and that really is how you add value.
Yeah, it is. And that's one of this is such an evolving business, and it'll continue to be an evolving business. And when I got into it, many years ago, it was really like, you sign a lease with Circuit City or Bed Bath & Beyond, and it's a 10-year lease, and then you just move on to your next project.
Right.
That's not what this business is today. It's constant curation. It's constant improvement. It's constantly looking for the nickels and dimes that fall between the sofa cushions. And if we're able to do that, I talk to our team about this all the time. If we can just do it a little bit more effectively than the next guy and, lower our cap rate a little bit and grow our income a little bit, that's what makes it us successful as a public company.
It's what makes you stand out.
Yeah.
Right? And leads to the bottom line growth.
Absolutely.
Sure.
That's always our goal. Like
of course.
The macro trends of the economy and the consumer spending and real estate and interest rates are out of our control. Mm-hmm. So we'll ride those waves with everybody else. And sometimes they'll be great waves and sometimes they won't. But the surfer has to ride whatever wave comes their way, and that's what we try to do.
Stay up.
Stay up in the bad and fly in the good.
Exactly.
Yeah, exactly.
What about sustainability? There's been a lot of conversation about sustainability, maybe to lower expenses, utilities, things like that,
yes.
Or maybe just investor demand, right, for the future. How are you working sustainability into your centers? And is this a big discussion point or not yet?
It's certainly a discussion point. We have a pretty robust sustainability program. We have a couple of employees who are dedicated to that, who know it really, really well. And our GRESB score, which is one of the measurement indices that are used for public companies who invest in sustainability initiatives in their real estate, has continued to go up and improve every year since I've been at Urban Edge. So we're definitely making progress in it. The art part of it comes from some of it makes a logical decision for cost. Like solar panels has been a lucrative area. EV charging has been an area that makes economic sense. You can actually generate a return on investments like that. And other parts of it are more gray. So when we talk about doing different things with composting and other things that we do on our property, we haven't seen a financial model yet that really proves all of that out. Is it coming? Is it not? Will we be able to get more electricity off of the grid? Will solar and other forms of energy be bigger parts of our business? I don't know. I'm hopeful that that's the case. But one thing we cannot do, and we won't do as a public company, is go so far out ahead of our skis that it costs our property money and our investors money. It is something that some of the big institutional investors look at and ask about and talk about. A lot of times with some of our European investors as well, they'll have a specific allocation towards companies that do more or less towards sustainability. So it's something we want to be focused on, but it's not something we do at the expense of, a profitable asset.
Sure, there's continual conversations on that as to when do you invest and hope that it returns to the bottom line, and when do you say it's not quite ready from a technology yet to be an integral part of our property.
Right, and what is the appropriate level of yield of return for an investment in something that is, a diminishing asset, right? Because the technology is changing so quickly.
Right.
When I build a building, even if that tenant leaves, that building is of value to the next tenant coming in.
Mm-hmm.
But that solar panel from 10 years ago is not of value to the solar tenant today.
Right.
So you have to model the returns on it a little bit differently.
Exactly. Be careful there.
Yeah.
Let's switch to failures. It's been a lot of softballs today, Jeff. It's really, I've been easy.
I got plenty of those.
But talk to me about a project that you thought was going to go a very different way. And it didn't, and you can be as specific as you can be or not, but what did you learn from that failure? And share with us what you can as to why things went differently.
Boy, that's a great question. I would say that when I first got in the business, like so many others, I was very, very ambitious about, fixing all of the real estate and maybe was a little bit less focused on yield. We had a project, this is going a long ways back, and it was out in Northern California, but we had a project that had a lot of vacant, untouched areas. And it was a good tenant lineup and it had good demand. And I was of the mind that if we took these vacant, untouched areas and we did like a mini soccer field and an amphitheater and all these amenities to bring, people with young kids in, and it would just turn that property into something else. And ultimately it didn't. It was an investment in the asset that ended up collecting a lot of dust because it wasn't utilized. So that taught me a couple of things. Number one is you have to understand your asset and know what you're investing for the customer who you are investing for. Really, really important. And that gets back to what we were talking about earlier about the art part of this is knowing the level of investment for a specific asset. And the other thing was it really reminded me that when you're doing an investment like this, you have to be thinking about not just how it's going to look on day one when you open your doors, but how is it going to impact your going forward costs for landscaping, your going forward costs for security? If that playfield that you built doesn't get used and all of a sudden it starts growing weeds because the tenants are complaining the landscaping bill's too high and you stop mowing the grass, that's not a good look for your center. So two things I learned from that, the takeaways were really to have a better understanding of my customer before I embark in any sort of a renovation of an asset, number one. And number two, to have a much more long-term view about the durability of the things that we're deciding to put into a property. Even now, we just approved a big renovation in Cherry Hill, New Jersey. And we had this pergola sitting in the middle of it. And it was a really nice, wooden, beautiful pergola. Well, we've just come through a pretty snowy season here in the Northeast, and I had visions of this pergola in 3 years not looking quite as nice as it looks in the rendering.
Easy to see. Yep.
And I swapped it out for a really, really cool, interesting sculpture that the team went out and found from a landscape architect in North Carolina. And it's going to wear better. It's going to look better over time. It's going to be cheaper to maintain. Probably would not have learned that lesson had it not been for some earlier failures.
Very interesting. The project in California that you were mentioning, it sounds like that was almost an entertainment forward situation, right? You were trying to put some concepts in that would drive traffic, probably a very large amount of square footage.
Yeah.
Has that scared you away from entertainment uses in general, or was that sort of an isolated flop because of other factors?
It has not scared me away from entertainment users, but the single best dollar you can invest in your shopping center is for the right tenant. At the end of the day, whatever you build, if you don't have the right tenants to drive that traffic, it's not going to help. So you have to be tenant focused and tenant forward first. That was not an entertainment center. And I tried to bring in amenities that would attract people who wanted to go there to be entertained, but without a Dave & Buster's or without a Top Golf or without some really cool something to generate traffic, it wasn't going to work on its own.
Right.
So we definitely will lean into the right entertainment concepts. We have a shopping center in Puerto Rico, actually, where we opened a 120,000 square foot entertainment concept called Sector 66, which generated almost $15 million of sales. And I think in its second year of operation, there's plenty of entertainment users out there that can drive the traffic. But you have to, as a landlord, you can't, tell yourself your own story too often and think that you can create that. You need the tenant partnership to bring entertainment to a property.
How do you balance the guarantee on a lease and the use? Right. Entertainment makes me think of that so clearly because maybe it's a newer concept.
Yeah.
Thinking pickleball a few years ago.
Right.
There's a lot of tenants that don't have credit. It's a very hot concept. How do you look at prospective tenants when it comes to who's behind the lease, the corporation or the guarantee versus the use?
Yeah. So with entertainment users in particular, who generally have not a lot of credit, I think we always try to make sure that at a minimum, we feel confident we're going to get our investment paid back. So if we're giving a certain amount of dollars, we really want to make sure there's enough credit there, whether it's a net worth statement or a personal guarantee or whatever else it might be, to at least get us to a point in the lease where we feel like those dollars are being paid back. It's also very important, and something that we did not do well as an industry 20 years ago, to understand where those dollars are going and how much of those dollars will be salvageable for the next tenant. And the perfect example of this.
Meaning the TI dollars?
Not just
giving?
the TI dollars, but also the landlord work dollars.
Oh, got it.
And the perfect example of this is the difference between a movie theater and a pickleball operator, right? So if you bring me a movie theater deal and a pickleball deal and they both need $300 a square foot of landlord's work,
right?
Odds are that pickleball work is going to be a level floor,
right,
a lot of bathrooms, high ceiling, maybe some plumbing, that kind of stuff. That movie theater is going to need sloped floors. It's going to need a whole bunch of other unique things that won't really be very helpful for the next guy in if it's not a movie theater.
And expensive to
and
even
super
roll back.
expensive to build, right?
That's what we've all learned.
Right. So one of the things as we've now entered this second or third generation of tenancy in some of these boxes that were built in the 80s and 90s and even earlier is there's a difference between a Kohl's going out of business and an AMC going out of business in terms of what you're going to have to do to get that space ready for the next tenant.
So does that make you shy away from swimming pool, lessons, the things, very heavy specialty use cases?
Yeah, it's so interesting you bring that up. Initially, it did.
Okay.
Because when I got in this business, and if you had a gym that had an LA Fitness in it, and that LA Fitness went out of business, oh man, how are we going to get this pool filled in?
Right.
And this is going to be so expensive. And it added, several dollars a square foot to your ultimate cost to make it habitable. But we just did a deal with a swim school, and we'll do more, by the way, with some of these swim schools that are geared towards teaching younger kids how to swim.
Right.
And their pools are very shallow. And with the way the technology and the construction techniques have advanced, they're not hard at all to backfill and replace. So it's funny when the team first brought me the deal, it's a Big Blue swim school and we opened up near Philly. I don't know why they call it Big Blue near Philly. That's dangerous. but when they first brought the deal, my initial reaction was, I hate filling in pools.
Right.
But they did a great job convincing me, and the tenant opened up a couple months ago and is doing great.
Interesting. All right. Well, I have a new view on that because that was
something that And then another area, Carly, where things are evolving on the construction side is in HVAC. I mean, air conditioning, as you know, has become one of the probably fastest rising and most expensive components of getting a space ready for occupancy for a tenancy. And now you're starting to see companies coming in with packaged units and different sorts of alternatives and wall-mounted units for smaller spaces. And we're slowly, and government rebates, we're slowly shaving down our HVAC costs. So open-minded to all of it.
The only way that construction costs are going to decrease is new technology.
I completely agree.
So we desperately need that.
I completely agree. And I would say that the single biggest change in my 20-something years in retail real estate has been not the way rents have grown or the way taxes have grown, but it's the way construction costs have grown and how that's made it so much more difficult to turn tenant A into tenant B.
It's true. It's a huge limiting factor right now. That's why we're seeing very little to no retail construction ground up.
Absolutely. And for us at Urban Edge, sometimes we're frustrated by that because we want to build new retail in our properties and the math doesn't work, as you said. Right. But for us, it's more of a competitive advantage than disadvantage because we own so many properties and we have such a low basis in our buildings that it allows us to invest in our buildings and still be able to rent them accretively.
Well, you have a very lucky advantage there.
Well, it's just time. I had an old boss tell me that real estate is the great, great business after the first 50 years.
Wow. Okay. It's good to know.
So it takes time.
Yeah, I think that's an understatement.
Yes.
What's one retail trend that everybody has been very excited about that you think will be a flop down the line, or maybe you're more hesitant on?
I don't know if I would say anything is a flop. What I would say is that as an industry, we're greedy and we tend to oversupply when we see a demand. So every business in the world is invention, imitation, decline, right? Doesn't matter what it is over some time period, maybe 1 week, maybe 100 years, it's invention, imitation, decline. So we've seen it in retail space with cupcakes and frozen yogurt and macaroons. So when I saw everybody rushing to develop pickleball, I think we at Urban Edge were a little bit more measured. You're now starting to see what I would call a flatlining on the QSR space, the bowl slop category, where great companies and great tenants like Sweetgreen and Cava and Chipotle and others have stabilized. Now, it doesn't mean they're going to be closing stores. It doesn't mean that that's a contracting or flopping business.
Maybe just saturation.
But it's just a little bit of, we've hit that point where we've gone from invention to imitation, and we're starting to see decline on the horizon.
Right.
So we have to, as landlords, be a little bit more cautious about some of the food deals we're doing. Food deals, as you know, require a lot of capital. They require time to get open, and restaurants in general don't always have a great track record of success. Now, obviously, Sweetgreen knocks on our door, Kava knocks on our door, we're answering and we're making deals. But we are definitely a little eyes wide open more about entering into some of the QSR categories that are seeming to flatline a bit.
Those are two of my favorites, so
Mine
you better
too.
be nice to them.
Mine too. I had Kava yesterday for lunch.
No, they're great, but I completely understand what you're saying. It seems like that's saturating for sure. What's your take on Amazon Fresh exiting the market?
Yeah.
This was really interesting news just a few weeks ago.
Yeah.
I think it's a positive for grocery overall, but how did you take that? And where do you think they... I actually don't even think it was a miss. I think it was intentional, but where do you think they could have repositioned to have a different outcome?
We speak to Amazon regularly, both by virtue of their Whole Foods real estate department and then the Amazon real estate department. We had several stores with them. We still have 2 stores with them as Amazon Fresh, and of course some with Whole Foods as well. So we're kind of, trying to keep our finger on the pulse of that company, but that company almost functions like its own government entity. It's so big.
Sure.
Yeah. And I don't think the real estate people are always the first to know what the long-term strategic decisions are from the absolute top. It's always disappointing when a retailer closes locations. I think as an industry, we have to stop pressing the panic button every time it happens. As a public company, we have these regular earnings calls every 90 days. And the questions are, what about Bed Bath & Beyond? What about Party City? What about Kirkland's or whatever it might be? This is the normal ebb and flow of our business. Right. There are concepts coming in and there are concepts going out. And it's ultimately a very healthy thing because we're in a rising rent environment. So in the case of Amazon Fresh in particular, once you swap out the downtime and the capital and the dust settles on the termination fees, most landlords will do better by getting those boxes back.
Right.
And there will be grocers that will enter their space. What I do find interesting about Amazon Fresh, though, they're a bit of a tweener size. They looked for locations that were somewhere between 30 and 45,000, whereas most of the grocers today, the big guys are all north of 50, the ShopRites, the Wegmans, the Stop and Shops, and then you have the ones who are a little more specialty oriented, like the Trader Joe's and the Sprouts, who are maybe south of 25,000 square feet. So finding the right tenant for the Amazon box is a little glass slippery.
Interesting.
And will take some time. I think you'll see some landlords be creative and maybe try to carve out some shop space.
Mm-hmm.
Certainly some of the ethnic markets will participate in that. There's some great local chains all over the country of grocers that are growing, and I think some of them will be bidders for it. I don't view it as a major negative in the industry. As for Amazon itself, I'm very encouraged by what they announced they'll be doing outside of Chicago. I don't know if you saw that, but they are trying to roll out this effectively a concept of a grocery store and a Costco combination with some distribution in the back that they announced in Chicago.
I actually did not see that.
Yeah.
Interesting.
I'll send you the link. I'm butchering what it is, but it sounds like a very interesting concept. And I love that that's a company that always is continuing to innovate, come up with new ideas. They have not found their sweet spot in the brick and mortar world yet. I think they would be the first to admit that. But you got to give them, credit for trying, and they're going to keep doing it until they figure it out.
And they're going to keep learning from Whole Foods.
Absolutely.
And every time you go into Whole Foods, it changes the way returns are processed.
And Whole Foods has a fantastic real estate department that's been there for a very long time and understands their customer and their markets exceptionally well. So Amazon and Whole Foods are now sharing a lot of real estate related information, and that's good for our industry.
So ultimately good for landlords.
Yes.
TBD where Amazon goes next in brick and mortar. Last thing on Amazon before we move on, what did you think of their just walk out technology that they abandoned? Do you think that has a place in the future of retail, or do you think that was kind of like a neat thing to try that we really don't need?
I think it's great. And I think it's, I was personally surprised it didn't work better. Mm-hmm. In my mind, that was as much about the offerings as it was about the people not liking the technology. You still see it in some airport places and things like that. I thought it was cool. I actually took my kids to Seattle when it first opened. And
that's dedication.
I pretended like I wanted to go to Seattle for vacation because I really wanted to see this. Yeah. So I'm a big fan of it. We have a tenant in Queens, New York, that has a similar technology built into their stores. Amazon has said, by the way, that they are still using that technology. They're just now more licensing it to other people who want to use it in their stores. So I actually think they're still going to try to make it part of mainstream retail, but maybe not just through just the Amazon stores.
Licensing fees instead.
Yeah, something like that. But we have a kosher grocer in Queens that, you drive your cart up onto like this big scale and it studies your scale and reads it and looks at it, and all of a sudden it tells you what you owe. So there's technology that's going to come that's going to make it easier for the customer. And I don't know why the just get up and go or whatever it was called didn't work, but I think the technology will be around in one form or another.
So we'll see 2.0.
2.0. So. I mean, everything takes a second iteration to make it start making sense.
Great.
Yeah, exactly.
Let's move on to markets. So you're up and down the East Coast, moving westward, I'm guessing, over time. Is there anywhere that you are especially bullish on, or on the converse, anywhere you think is overbuilt, or maybe you're not seeing the same growth?
Sure. Yeah. I have always, and I've said this before, I've always thought that Boston, Metro Boston, was one of the most appealing investment markets in the country for what we do. And I'll tell you why. Generally, I would like to look for places that have geographic and political barriers to entry, meaning you can't just, start with a city center and just extrapolate out from all directions from there. So if you think about a place that's in the Midwest or a place like Orlando that doesn't have sort of water on either side, to me, that's always a little scarier to go down and buy an existing asset in, because you're always competing against something new 10 miles east or west. Boston, by virtue of the way it's physically situated and by virtue of the fact that it was built at a time when we really didn't have much of a road network or car dependency in this country, has a very limited number of what we would call power centers or large retail centers relative to the population size. And they're not going to be able to build anymore. The days of people building in metro markets, single level surface parked retail centers are probably long gone. Right. So if you can get your hands on one of them, and they're owned by some of the best companies in the country, not just us, but companies like Eden's and Federal and Regency, if you can get your hands on one of them, they're generally going to be assets that appreciate
and stable over time.
Right.
So supply constraints.
Supply constraints. I really focus on supply constraints more than anything else. When we talk about markets that maybe we're not as bullish on, I think we as a company are highly sensitive to trying to, as the expression goes, skate to where the puck is going and not where it is. And sometimes we look at investing in some of these high growth Southeast markets or Metro Phoenix markets, whatever they might be. And we wonder, are we too late? Because the pricing that sellers might want for assets in those markets really requires growth over the next 10 or 15 years to be just as good, if not better, than growth over the last 10 or 15 years. And we like our markets. I have to tell you that I think that DC to Boston corridor, although it is not new and then it is not as exciting and it maybe doesn't command the same eye-popping number of housing starts, this is where the jobs are. And where the jobs are is always going to have a connectivity to where the people are going to have to be and want to be. If you can get an asset in a first-ring suburb of New York City or a first-ring suburb of Boston or Washington, D.C. or Philadelphia or any sort of major metro market, odds are that that's going to do better over time than somewhere that's dependent on, population swings that are not job dependent.
And the dilution, right, of the consumer through sprawl, through building. I think that was a fantastic point, right? Because if you can keep building a new shiny center that's maybe 5 miles up the road,
exactly,
there's only so many people there to keep up with that growth from a construction
and that's
standpoint.
one of the reasons we look at replacement cost as one of the factors, right? When we're buying a shopping center, what are we paying per acre? What are we paying per square foot on replacement cost? And if the day after we close, every tenant walked out the door and left, are we high-fiving or are we wringing our hands?
Right.
And generally, we want to be in things at a below replacement cost, at a low per acre price. The Urban Edge portfolio has been around so long, and our assets are so dense, are in markets that are so dense that if we were to lose some of our biggest and best retailers in some of these markets, we would actually probably have more value in these assets as land.
It's amazing.
Now, that doesn't mean Home Depot is closing their store in Hackensack anytime soon.
Right.
But it does mean that we have this really stable floor under us to know that our bottom line is as protected as it can be.
That has to make your acquisitions very difficult, though, right? If you're looking for low basis and core markets, right?
Yeah.
A constrained supply pipeline to the market, that's tough. How are you finding new deals?
What makes acquisitions most difficult as we go through the various cycles of the real estate industry is when there's capital being invested that doesn't fully understand retail. At various points in time, you will see institutional capital flock in or flock out of retail real estate. And when it's out and you're competing against people who understand the CapEx reinvestments that's needed in properties, that understand not every space is going to be leased at 5% a year annual increases and 100% occupancy every year, as some of these models say. It's a very healthy competition, and it's a very vibrant and fun market to play in. When we start running up against investors, often who are coming in as sponsors with money that they've raised from other sources, and they are able to sort of make their spreadsheet say whatever they need to make their spreadsheet say to solve for their necessary IRR, that's when we usually get priced out. We have great relationships with local brokers. We have great relationships with some of the bigger sellers, and we try to leverage our reputation as a credible buyer. We don't retrade price. We want to get to the closing table as quickly as possible. We're buying all cash. So we use those levers when we can, but ultimately, sometimes you can't win on price. And that's been happening more in the second half of 25 and into 26 than it did in 23 and 24. In 2023 and 2024, and the first half of 2025, we bought $700 million of property at roughly a blended 7.2% yield. And we sold about $500 million of property in the low fives yield. So we generated a really healthy spread between what we bought and we sold.
Yeah.
And more importantly, we bought assets that we think are going to grow faster and better than the ones we sold in markets that we like even more.
Because of relationships.
Some of it was relationship. I would say of that 700, a lot of that was Jeff Olson, our CEO, myself, picking up the phone, reaching out to our relationships and getting things done.
Right.
That's not as easy when there's 5 bidders on the asset instead of 2. So we haven't been able to duplicate that success, but we're out in their markets trying every day. And we actually do have one asset that we're closing on in a few weeks in Bridgewater, New Jersey, that we're super excited about, that hits all of those qualifications, but it's hard work. It's hard work.
Patient capital.
Yeah.
And as retail becomes more in vogue and there's more investor interest, I could see where that competition would get more challenging for you. But I'm sure you're staying disciplined and finding only the right opportunities.
Yeah, you have to. You have to stay disciplined, but it's a good thing. I don't remember a time since I've been in retail where the metrics, the fundamental operating metrics of rent growth and tenant demand were this good, coupled with an investing environment where institutional investors were looking at retail as a more favored asset class than, say, apartments or industrial. So, you need cheap money, you need a lot of investors, and you need good metrics. And we have a little bit of a perfect storm happening right now where all of that has come together. Who knows how to say how long that lasts, but while it lasts, it makes buying very difficult and selling a lot more fun.
Exactly. I've heard from many people that we're expecting 26 to be sort of a banner year for retail because all these factors are coming together at the same time. So, like you said, very difficult to buy, great time to sell, and not too bad of a time to be an operator either.
No,
a lot of tenant demand.
But to take the pessimist view, it's no different than, self-serve yogurt opening up on every corner. At some point, the great ones will survive and the lousy ones will take a loss.
Right.
So really important for us that we buy the asset that is the best or second or third best asset in the market and be the consolidator and not the consolidatee. And I do think that some folks are sharpening their pencil a little too tight right now and might end up being disappointed in what the market actually yields on some of those investments.
That's good caution and good advice. To that end, do you have any thoughts or advice for maybe new retail owners? Maybe someone who's buying their first small strip mall or someone who's entering the industry. You've dished out a lot of great points already, but anything you would say really they should be focused on that usually gets missed?
Yeah, well, I would say it this way. The old axiom that real estate is location, location, location. My version of it would be that real estate is location, location basis. Meaning your location is still probably the single most important thing. But you really have to understand, I think the first boss I ever had in real estate told me you make your money going in, not going out. So buying an asset at the right price, and this gets back to those conversations about replacement cost and per acre and things like that, is very, very important. If you buy a rent roll, and that rent roll is inflated, ultimately you have a real risk of being disappointed. If you buy vacancy at a low price and all you got to do is roll up your sleeves to get it fixed and leased and your basis is attractive, you're going to be in a much better long run position. I also would caution anybody to think that this is a business that they can make their hit on in 3 years and get out. That's possible. If you time it right, that's certainly possible. But you make your money either with timing or time. As a REIT, as a big company, we choose time, and generating consistent, solid 2, 3, 4, 5, 6% returns year over year, that NOI growth year over year is ultimately what leads us to assets that are worth 2 or 3 times as much as what they were when we started. It's not a business plan where we say we're going to buy it for $100, put $20 in and sell it for $200. That's hard to do. And if you're just in that business, you're going to have some L's as well as some W's.
I think you said that absolutely perfectly, right?
Okay.
Because
now I got to go out and do it.
Now, well, you have been doing it. That's the key, right? But I mean, there's so many pieces to this because you can look at a center that's 50% vacant and see all upside without seeing the risk and without looking at the rents of the tenants that are already there. Maybe they're above market and that's why tenants are leaving. Maybe there's deferred maintenance. There's so much to it.
And where does the growth come from? Like, for instance, our team will bring a deal in and they'll say it's got, 4% CAGR, which is, annual growth a year. And I'll say, okay, well, from where? Like, was there vacancy?
The
vacancy's never been leased in 20 years because it's, a back room in a corner somewhere. And, it
doesn't count then.
Right. Doesn't count. It's because we assume McDonald's is going to happily double their rent in 4 years.
Right.
Doesn't count. So really studying where the growth opportunity is and not just looking at it on a piece of paper is an important part of it.
The last thing I wanted to touch on before we wrap up is rent levels. Have you had a lot of tenant pushback on rent levels? Are you getting pushback on renewals, or are tenants keeping up with the pace of rent growth overall?
So I'd bifurcate it as the shops and the anchors. The shop business in general, shop tenants have less negotiating leverage than big national anchor tenants do. So they've been force-fed 3, 4, 5% annual rent increases over the last several years, right? It's a lot. Mm-hmm. When you couple that with what in most jurisdictions has been increases in taxes, in insurance, in common area maintenance, their overall check size that they're writing every month could be somewhere between 10 and 20% more than it was 3 or 4 years ago. That's a lot. And I do think that we're hitting a point with shop space where we're going to start hearing no mas a little bit, and you're going to see some store closures. You're going to see some franchisees who were maybe thinking that they would get a more lucrative franchise model than it worked out to be, and you'll have some pushback on that. As it relates to, the 10,000 square foot and up type tenants, a lot of them have largely been on the sidelines for many years and are now only in the last few years scrambling to add to their fleet, to add to their store count. And when they do, they can't be as price sensitive as they used to be.
Or they would never expand, right?
Or they just can't expand because now there is 2 or 3 seats for, people for every seat instead of the other way around. It used to be we had 1 vacant space and, there was nobody for it. And now we have 2 or 3 people for it. It totally changes your leverage.
Right.
So I would say that there is room to grow on 20,000 square foot apparel rents. There's room to grow on grocery store rents, things like that. Where we do see a lot of pushback from them is they still want, forever and a day in options, and they still want to pay option rents that are well below what inflation would be. So you have to have your eyes wide open when you sign these deals that someone's going to look in a desk drawer in 12 years and say, what did this guy do? Yeah. Right. What kind of an idiot signed this?
Yeah.
But we've had some success. I'll just give you a quick anecdote. I won't name tenant names, but we've encouraged our leasing team now. When it used to be 6-12 months from a lease expiring, they used to go to the tenant and say, do you want to stay? Right? We've encouraged them now. Well, don't go do that yet. Go hit the market, find another deal.
So you have leverage.
And walk in and say, sorry, I have someone else for your space. So we did that with 2 national tenants at a shopping center. And we got a very good national tenant to commit to a rent that was, let's call it 20% higher than what the existing national tenant was paying. And these are all very important relationships. So you have to be very above board and honest with everybody. But we went in and sat down with this real estate rep who we know and like very much and said, we got these guys, like, you need to step up to this number or we got to go do this other deal. And, he's got a boss too. So he's got to take it up the chain. And they came back and say, all right, well, we don't have a choice. We can't lose the location. Now, if we had started with, hey, do you want to stay? Never would have gotten to that same number.
They would have just said yes.
And would have been a 5% increase or whatever else it might be.
Very smart.
These are tools that we didn't have at our disposal as retail landlords, even 5 years ago. And I think all of us who are in the business are excited to finally be able to break out the big guns a little. Now, it's not a landlord-tilted field because at the end of the day, we still need to keep our shopping centers full, but it's no longer a tenant-tilted field the way it has been for so long. It's an even playing field, and that's what makes it fun.
And I think the bifurcation of the tenants is an important piece of that puzzle, like you just said, right? There's a huge difference between small shop space and franchisees, the smaller tenants and the nationals.
Yes.
So how you negotiate with them is probably very different.
And tenant allowance, landlords work. We've had much, much more success in reducing the scope of, used to be, well, I want my box exactly how I want it. And I don't care that you have these air conditioning units. I want those air conditioning units. And now we're sort of saying, this is what it is, take it or leave it. That's been probably the most impactful area, is that retailers have learned to live with less. They've learned to get by with less capital and still open beautiful stores. And that's saved a lot of money for us as well.
And time, I'm sure, if you're not special ordering specific parts.
Yes, absolutely.
Money is time, and now you're improving both. So
yeah, and money being time is a piece of this thing that we all tend to sometimes forget. And it's a huge component of the analysis of every deal we do at Urban Edge.
Jeff, this has been amazing. So
much fun.
So many nuggets, so much good information. I'm sure our listeners will get a ton of value from this. So thank you very much for your time today.
It was great. Thanks so much for having me, Carly.
And we wish you all the success in 2026 and can't wait to see the next Urban Edge project.
Thanks so much.
To everyone listening, that was this episode of Commercial Real Estate Now. We're so happy you tuned in, and we look forward to seeing you again very soon. Have a great day, everyone.